1. Dollar cost averaging, DCA. Invest a fixed amount regularly, regardless of market conditions, to reduce the impact of short-term market volatility. 2. Value investing. Invest in undervalued stocks or assets that are selling for less than their intrinsic value, as identified through financial analysis. 3. Growth investing. Focus on companies with strong growth potential, even if they are priced higher than current earnings would suggest. 4. Index fund investing. Invest in index funds that track broad market indices, e.g., S&P 500, to gain exposure to a diversified range of stocks. 5. Dividend investing. Invest in stocks or funds that pay regular dividends, providing a source of income in addition to capital gains. 6. Buy and hold strategy. Purchase investments with the intention of holding them for the long term, regardless of short-term market fluctuations. 7. Asset allocation. Spread your investments across different asset classes, stocks, bonds, real estate, commodities, to reduce risk and increase potential returns. 8. Sector rotation. Shift investments between different sectors of the economy based on the current economic cycle to capitalize on growth trends. 9. Contrarian investing. Invest in assets or stocks that are currently out of favor, believing that they are undervalued and will eventually rebound. 10. Real estate investment. Invest in property, whether directly or through real estate investment trusts, REITs, to generate rental income and capital appreciation. 11. Momentum investing. Buy assets that have shown upward price trends, with the expectation that they will continue to rise. 12. Risk parity. Balance your portfolio by allocating assets based on their risk, not just dollar amounts, to achieve optimal diversification. 13. Tactical asset allocation. Adjust your asset allocation based on short-term market conditions or economic outlook, aiming to maximize returns during market shifts. 14. Value averaging. Invest a predetermined amount that adjusts based on the market's performance, buying more when prices are low and less when prices are high. 15. Private equity. Invest in private companies or startups with the expectation of high returns through business growth or an eventual public offering. 16. Hedging. Use financial instruments like options or futures to protect your portfolio from market declines or to lock in profits. 17. Socially responsible investing. SRE. Invest in companies that align with your personal values or that focus on sustainability, environmental impact, or social issues. 18. Peer-to-peer lending. Invest in loans made to individuals or businesses through online platforms, generating returns through interest payments. 19. Tax-efficient investing. Choose investment vehicles, e.g., tax-deferred or tax-free accounts, to minimize taxes on your investment gains. 20. Short selling. Borrow shares and sell them with the aim of buying them back at a lower price, profiting from a market decline. 21. Covered call. Writing. Own stocks and sell call options on those stocks to generate extra income while holding the stock. 22. High yield bonds. Invest in bonds with higher yields and higher risk to generate income, especially if interest rates are low. 23. Cryptocurrency investing. Invest in digital currencies like Bitcoin or Ethereum, either directly or through crypto-related assets, as part of a diversified portfolio. 24. Right investing. Invest in real estate investment trusts, which own or finance income-producing real estate properties, providing exposure to the real estate market without the hassle of direct ownership. 25. Dollar cost averaging. In ETFs. Invest a fixed amount in exchange-traded funds, ETFs, over time to reduce risk and improve long-term returns. 26. Buy the dip. Invest in a stock or asset after a market pullback, believing that the asset is temporarily undervalued. 27. International diversification. Invest in foreign markets to reduce home country bias and benefit from growth in global markets. 28. Small cap investing. Focus on investing in small cap companies, which can potentially deliver high growth but come with more risk. 29. Large cap investing. Invest in well-established, large companies that have a history of stability and growth. 30. Emerging markets investing invest in developing countries or markets with high growth potential but also higher risks. 31. Commodities investing invest in physical goods such as gold, oil, or agricultural products to hedge against inflation or diversify your portfolio. 32. Inflation-protected securities invest in government bonds or other securities that are designed to protect against inflation. 33. Systematic withdrawal strategy. Use a planned strategy to sell portions of your portfolio over time, typically used in retirement to create a stable income stream. 34. Leveraged ETFs. Invest in ETFs that use financial derivatives to amplify returns, typically for short-term traders looking to capitalize on volatile markets. 35. Value-weighted indexing. Invest in an index based on the market capitalization of the constituent companies, where larger companies receive a higher weight. 36. Dividend growth investing. Focus on stocks or funds that not only pay dividends but have a history of growing their dividend payouts. 37. Index fund tax loss harvesting. Offset capital gains taxes by selling investments that have declined in value and using the loss to reduce taxable income. 38. Options trading. Use options as a way to hedge your portfolio, generate income, or speculate on price movements with limited risk. 39. Value traps avoidance. Be cautious of stocks that appear undervalued but have fundamental problems that could result in long-term underperformance. 40. Artificial intelligence (AI)-driven investing. Use AI-powered platforms to analyze large datasets and optimize your investment strategy. 41. Peer-to-peer real estate lending. Invest in real estate loans through peer-to-peer platforms, generating income from interest paid by borrowers. 42. Municipal bond investing. Invest in bonds issued by local governments or agencies, often providing tax-free interest income. 43. Thematic investing. Invest in trends or themes, such as clean energy, artificial intelligence, or biotechnology, that have long-term growth potential. 44. Growth at a reasonable price. GARP. Invest in companies with growth potential but at reasonable valuations, avoiding overvalued growth stocks. 45. Alternative investments. Explore non-traditional investments such as art, collectibles, wine, or venture capital, to diversify beyond stocks and bonds. 46. Robo-advisors. Use automated platforms that create and manage a diversified portfolio based on your risk profile and financial goals. 47. Capital preservation. Focus on protecting your capital with low-risk, low-return investments, often used by those nearing retirement. 48. Value-weighted bond funds. Invest in bond funds weighted by the market value of the bonds they hold, offering a diversified bond portfolio. 49. Crowdfunding investments. Invest in startups or small businesses through crowdfunding platforms, often in exchange for equity or debt. 50. Social impact investing. Invest in companies or projects that aim to generate social or environmental impact in addition to financial returns.